Good morning, and welcome to episode 280 of Getting Rich. I'm your host, Rich Chekin, president of Asset Strategies International, and today is Wednesday, June 10th, 2026. Negotiations continue between the U.S. and Iran amid a fragile peace, if you can call it that. Overnight, the U.S. attacked early warning and air defense sites along the Straits of Hormuz in response to a U.S. Apache helicopter being shot down by an Iranian drone. Gold tumbles in part on that news, but more as a result of the impending consumer price index print due out today at 8:30 a.m. Let's take a look at the numbers over the past week, and they are not pretty for the precious metals. Gold is down 6.4%, trading at 4,175.10. It was 4,459.10 last week. Silver's down 13.3%, trading at 64.58 an ounce. It was $74.48 an ounce last week. Platinum's down 12.8%, not much better, trading at 1,684 an ounce. It was 1931 an ounce last week. And palladium down 9.2%, trading at 1,247 an ounce. It was 1,374 an ounce last week, with gold performing much better than silver by falling much less over the past week. Your gold-silver ratio is up. It's going to take more ounces of silver to buy that ounce of gold. This week, that number stands at 64.65. It was 59.87 last week. And the dollar is showing a little bit of strength, not a lot. Still below 100, trading at 99.91 on the index against its legacy currency trading partners. It was 99.33 last week. So gold now has fallen 25% this year from its January 29th high near $5,600 per ounce. So my question to you is, do you think gold will fall below $4,000 before resuming its upward trend? And if so, why? I'd love to hear from you. The fall in gold's price is due primarily to the fears of inflation accelerating. Rate increases by the Fed next week could potentially happen. If we see a reading of the CPI of the expected 4.2% or higher, that may very well force the Fed's hands sooner than expected to increase interest rates. Now, again, interest rate increases are bearish typically for gold. Again, at current levels, I don't see it. We're still having a negative real return on your funds if you put them in term deposits, given the rate of inflation. And with inflation creeping up, that's not getting better. So there's still really no opportunity cost right here to owning gold versus some sort of a term deposit. But as we creep higher to higher single-digit, lower double-digit interest rates, yes, I do agree it becomes negative or bearish for gold. We're nowhere near that point yet, but people are acting like we are. We're going to discuss this and everything going on currently in the economy when Adrian Day, my co-host, and I welcome Mark Thornton from the Mises Institute at our very next episode of On the Move. That webinar will take place a week from today. So Wednesday, June 17th, 7 p.m. Eastern Time. Please join us. If you have not registered already, go ahead and do so. You can do so at the link below this video. As always, we'd like you to go ahead and subscribe to our YouTube channel. Check out the recent interview I did with Porter Stansberry. It's a very important eye-opener announcing his new book. Take a look at that, and if you haven't, subscribe or buy his new book, and then join us at the farm in September for his conference. Go ahead and follow us on social media. Take our twice weekly, always something interesting alerts, and our once monthly information line newsletter. But in the end, don't ever forget, getting rich starts with keeping what's yours.